Mr. AG here, Asian guy bringing you the complete picture. Gold just rebounded to $5,000 per ounce. Let me say that again because after everything we have witnessed over the past week, this is significant. $5,000. Gold is back. After the biggest single-day crash since 1983, after margin hikes forced mass liquidation, after 30-day volatility spiked to over 44%, the highest level since the 2008 financial crisis. After all of that chaos, gold is back at $5,000. And now JP Morgan has just revealed their price target for the end of 2026, $6,300 per ounce. That is not some random analyst on the internet. That is JP Morgan, one of the largest financial institutions in the world, saying gold is going another 26% higher from here. And they are not alone. UBS is targeting $6,200. Deutsche Bank and Société Générale see $6,000 or higher. Every major bank remains bullish despite the historic volatility we just experienced. Let me break down exactly what happened, why it happened, and what this all means for where gold goes from here. Before we dive in, let me be absolutely clear about something important. I do not sell courses, I do not sell signals, I do not sell mentorships, I do not have any paid products of any kind. I share this analysis because so many of you have told me this content helps you understand what is really happening in markets, see both sides of every situation, and make more informed decisions. That is why I do this. I present the data. I show you what the bulls are seeing and what the bears are seeing, and I let you decide. Now let me get into what actually happened, because understanding the crash helps you understand why the recovery matters so much. Drop a comment right now. Where are you watching from? What country? What city? I want to see how global this community has become. And while you are down there, tell me if you bought gold during the crash or if you sold. Did you add to your position at lower prices? Or did you get shaken out by the volatility? I want to hear your real experience. Let me know in the comments. Now let me take you through what happened. Gold had been climbing to record levels for months. Rising global conflicts, financial instability, central bank buying, de-dollarization trends. All of these factors were driving gold higher. The metal was in a clear uptrend and sentiment was overwhelmingly bullish. And then January 30th happened. Gold experienced its largest single-day drop since 1983. Not since 2008. Not since 2020. Since 1983. That is over 40 years. This was a historic crash by any measure. What triggered it? The answer is margin hikes. CME Group raised margin requirements on COMEX gold futures from 6% to 8%. They raised margin requirements on COMEX silver futures from 11% to 15%. That might sound like small numbers, but the impact was enormous. When margin requirements increase, leveraged traders must either post additional cash as collateral or reduce their positions. If you are holding $1 million worth of gold futures and the margin requirement jumps by 2 percentage points, you suddenly need significantly more cash to maintain that position. If you do not have that cash readily available, you have one choice: sell. And when thousands of traders are forced to sell simultaneously, prices crash. This is exactly what happened. The higher cash requirements forced many leveraged traders to reduce positions quickly. This increased selling pressure dramatically. The selling triggered more selling. Stop losses were hit, more positions were liquidated, and a chain reaction led to widespread liquidation across precious metals. Gold crashed. Silver crashed even harder. The one-day losses were steep, and the short-term volatility was unlike anything we have seen in decades. Let me give you a number that puts this in perspective. During the sell-off, gold's 30-day volatility rose to over 44%. 44%. That was the highest volatility level since the 2008 financial crisis. And here is something that should surprise you. Gold's volatility during this period actually exceeded Bitcoin's volatility, which was approximately 39%. Let me repeat that. Gold, traditionally seen as the ultimate safe haven asset, the boring stable store of value, was more volatile than Bitcoin during this crash. That is extraordinary. Gold was behaving like a speculative instrument rather than a defensive asset. But here's where the story gets interesting. Despite that extreme volatility, despite the historic crash, despite all the chaos, gold recovered. And it recovered fast. Let me ask you something. What time is it where you are right now? Morning? Afternoon? Late night? Drop it in the comments. I am always curious to see when people are engaging with this content. Are you watching before markets open to prepare, after markets close to understand what happened, during your lunch break because you cannot stop thinking about precious metals? Let me know. Now let me walk you through the recovery because it tells us something important about gold's resilience. Buying interest returned during Asian trading on February 3rd and 4th. Asian buyers stepped in. They saw the crash as an opportunity, not a reason to panic. Spot gold rose about 2% in 24 hours to settle near $5,001 per ounce. Silver followed a similar trend, rising about 7% in the same 24-hour period. And here is something that should make every gold investor feel validated. While gold rebounded 2% and silver rebounded 7%, Bitcoin continued to lag. Bitcoin fell more than 3% over the same period. The supposed digital gold could not match actual gold's recovery. When the dust settled after the most volatile week in precious metals since 2008, gold came out ahead. That tells you something about which asset investors truly trust when things get chaotic. Let me put the longer-term performance in context because this is critical for understanding why banks remain so bullish. Over the past 12 months, gold has risen roughly 66%. 66% in 1 year. That is an extraordinary return for any asset class, let alone one traditionally considered slow and steady. Over that same 12-month period, Bitcoin fell about 21%. Gold plus 66%. Bitcoin minus 21%. The narrative that Bitcoin was replacing gold as the safe haven asset has been completely demolished by actual performance data. Now let me get into what the major banks are forecasting, because this is what everyone wants to know. Where does gold go from here? JP Morgan expects gold to reach $6,300 per ounce by the end of 2026. That is their official target, 26% higher from current levels. And their thesis is supported by steady demand from central banks. JP Morgan anticipates gold acquisitions by central banks of approximately 800 metric tons. 800 metric tons of central bank buying. That is massive institutional demand that is not going away regardless of short-term volatility. UBS has adjusted their target to $6,200 for March, June, and September 2026. They are even more aggressive on timing than JP Morgan. They see gold hitting $6,200 before the end of September. Their optimism reflects similar confidence in ongoing demand and favorable market trends. Deutsche Bank and Société Générale project gold to remain around $6,000 or slightly higher. They are slightly more conservative than JP Morgan and UBS, but still see significant upside from current levels. Every major bank that has published a forecast is bullish. Every single one. Let me pause here and ask you something. How many of you own gold right now? Physical gold, gold ETFs, mining stocks, futures, any form of gold exposure. Drop it in the comments. And if you do not own any gold, tell me why. Is it the volatility we just saw? Is it the price seeming too high? Is it something else? I want to understand what is keeping people on the sidelines. Now let me explain the thesis behind these bullish forecasts, because understanding why banks are bullish helps you evaluate whether you agree with their logic. The first pillar is central bank demand. Central banks around the world have been accumulating gold at record rates. They are diversifying away from US dollar reserves. They are preparing for a world where the dollar may not be the dominant reserve currency forever. JP Morgan's estimate of 800 metric tons in anticipated purchases represents just the publicly announced intentions. Actual buying could be higher. When central banks are net buyers of any asset class, that creates a consistent bid under prices. It provides support during pullbacks, and it absorbs supply that might otherwise push prices lower. The second pillar is geopolitical tensions. Over the past 6 months, heightened global tensions and persistent economic pressures have continued to drive interest in precious metals. Investors are monitoring developments in the Middle East. President Trump has indicated potential negotiations on the nuclear agreement with Iran. Any escalation in tensions typically drives safe haven flows into gold. While any progress in diplomacy could temporarily reduce demand for defensive assets, the baseline level of global uncertainty remains elevated compared to historical norms. The third pillar is monetary policy. Anticipated reductions in U.S. interest rates during the remainder of 2026 are expected to support gold prices. Gold does not pay interest or dividends. When interest rates are high, there's an opportunity cost to holding gold instead of interest-bearing assets. When rates fall, that opportunity cost decreases. Gold becomes relatively more attractive. The market is pricing in rate cuts, and if those cuts materialize, gold should benefit. The fourth pillar is inflation. Ongoing inflationary pressures are likely to sustain gold's appeal among investors. Gold has traditionally been viewed as an inflation hedge. When the purchasing power of fiat currencies declines, tangible assets like gold tend to retain value. As long as inflation remains above central bank targets, demand for inflation protection supports gold prices. About 60% of you watching right now are not subscribed to this channel. If this analysis is helping you understand the complete picture, if it is showing you what major banks are seeing and why they are positioned the way they are, consider hitting subscribe. I do not do hype. I do not do fear-mongering. I give you the data and let you make your own decisions. If that approach resonates with you, subscribe. Now let me address the volatility we just experienced because it was extraordinary and deserves explanation. Gold's 30-day volatility rising to 44% was the highest since 2008. That is not normal for gold. Gold is supposed to be the stable asset, the boring one, the thing you own precisely because it does not move like Bitcoin or tech stocks. And yet, during this crash, gold moved more violently than Bitcoin. What does this tell us? It tells us that the paper gold market, the futures market, has become heavily speculative. Leveraged positions had built up excessively during the rally. When margin hikes forced liquidation, those leveraged positions unwound violently. The volatility was not in the physical gold market. Physical gold did not become 44% more volatile in terms of its actual value as a store of wealth. The volatility was in the paper derivatives market that is supposed to represent gold's price. This is an important distinction. If you own physical gold, the volatility in paper prices is concerning but not existential. You still own actual metal. You cannot be margin called out of physical gold. You can hold through any storm. If you own paper instruments like futures or certain ETFs, you are exposed to the mechanics of the paper market. Margin hikes can force liquidation regardless of your long-term view. Volatility can trigger stop losses and push you out of positions at the worst possible moment. The lesson from this crash is that the paper market and the physical market are not the same thing. They usually move together. But in moments of extreme stress, they can diverge dramatically. And when they diverge, it is the paper market that becomes unhinged while physical reality remains unchanged. Quick question for the community. Do you own physical gold or paper gold or both? Drop it in the comments. I'm asking because your answer determines how you should interpret the volatility we just experienced. Physical holders can view this as noise. Paper holders need to think carefully about position sizing and leverage. Now, let me give you the bearish case because I always present both sides. The bulls are not telling you everything and you deserve the complete picture. The first bearish concern is that gold at $5,000 is expensive by historical standards. Yes, banks are projecting $6,000 plus, but gold has already risen 66% in 12 months. Trees do not grow to the sky. At some point, the rally exhausts. At some point, buyers become saturated. At some point, prices need to consolidate or correct. We may have just seen that correction, or we may see more. The second bearish concern is geopolitical de-escalation. If Trump's negotiations with Iran succeed, if China-US relations improve, if global tensions broadly decrease, the safe haven premium in gold prices could evaporate. Gold benefits from fear. Less fear means less gold demand. Any breakthrough in diplomacy could trigger profit-taking in gold. The third bearish concern is dollar strength. The dollar has been strengthening recently on Warsh nomination expectations and other factors. A stronger dollar makes gold more expensive for international buyers. If dollar strength continues, that is a headwind for gold prices, regardless of other factors. The fourth bearish concern is that the extreme volatility may have damaged investor confidence. When a so-called safe haven asset drops more than 12% in a day and exhibits higher volatility than Bitcoin, some investors question whether it deserves the safe haven label at all. Confidence, once lost, can take time to rebuild. Some investors who were burned by the crash may not return quickly. The fifth bearish concern is margin hike risk. CME has demonstrated willingness to raise margins aggressively during volatile periods. If gold rallies strongly again, another round of margin hikes could trigger another round of forced liquidation. The paper market remains vulnerable to this dynamic. Bulls need to account for the possibility that any strong rally could be met with margin increases that trigger another crash. That is the bearish case. It is real, and it needs to be considered alongside the bullish thesis. Now let me give you the bullish case in more detail because the banks are not bullish without reason. Gold survived the biggest crash since 1983 and recovered within days. That is resilience. That tells you the underlying demand is real. That tells you buyers are waiting at lower levels. That tells you this is a bull market that is not easily killed. Every major bank remains bullish with targets between $6,000 and $6,300. These are not small institutions making wild guesses. These are JP Morgan, UBS, Deutsche Bank, Société Générale. They have armies of analysts, access to proprietary data, and reputations to protect. They would not publish targets this bullish if they did not have high conviction. Central bank demand of 800 metric tons anticipated by JP Morgan provides a structural floor under prices. Central banks do not trade on momentum. They do not panic sell during crashes. They accumulate systematically over time. That consistent demand absorbs supply and supports prices. Gold outperformed Bitcoin over the past 12 months by a wide margin, plus 66% versus minus 21%. The market has voted on which asset is the true safe haven, and the market has chosen gold. Rate cuts are coming according to market expectations. When rates fall, the opportunity cost of holding gold declines. Gold becomes more attractive relative to interest-bearing alternatives. This is a tailwind that should persist through the remainder of 2026. Inflationary pressures remain elevated. The purchasing power of fiat currencies continues to erode. Gold provides protection against that erosion. As long as inflation remains a concern, gold remains relevant. Physical demand remains strong globally. Asian buyers stepped in immediately during the crash to accumulate at lower prices. Shanghai premiums over Western prices indicate strong physical buying. The paper crash was not matched by a physical crash. Gold has risen 66% in 12 months, and banks still see another 20 to 26% upside. That is extraordinary bullishness from institutional sources, who are typically conservative in their forecasts. Let me share something about the silver recovery as well, because silver is part of this story. Silver rose about 7% in 24 hours during the rebound. That was an even stronger bounce than gold on a percentage basis. Silver tends to be more volatile than gold. It falls harder during crashes and rises faster during recoveries. The silver rebound alongside the gold rebound suggests broad-based buying returning to precious metals, not just a single asset recovery. I want to ask you directly, based on everything I have shared, what is your outlook for gold for the rest of 2026? Do you think we hit JP Morgan's $6,300 target? Do you think we see another crash first? Do you think we trade sideways in consolidation? Drop your prediction in the comments. I want to see what this community collectively thinks. Now let me talk about what I am watching going forward, because the picture should become clearer over the coming weeks. Watch the $5,000 level in gold. That is psychological resistance and support. If gold holds above 5,000 and builds a base, that is constructive for higher prices. If gold fails to hold 5,000 and breaks back below, we could see another leg down. Watch the dollar index. Dollar strength or weakness will have a significant impact on gold's trajectory. If the dollar reverses its recent strength, that removes a headwind. If dollar strength continues, gold faces ongoing pressure. Watch for additional CME margin changes. If margins are raised again, another round of forced liquidation could occur. If margins are held steady or reduced, that would be a positive signal for market stability. Watch central bank buying data. The World Gold Council and other sources publish data on central bank purchases. If buying remains strong or accelerates, that supports the bullish thesis. If buying slows, that raises questions. Watch geopolitical developments. Any escalation in Middle East tensions, any deterioration in U.S.-China relations, any new conflicts would drive safe haven flows into gold. Any de-escalation or diplomatic breakthroughs could reduce safe haven demand. Watch Fed communications. Any clarity on the path of interest rates will impact gold. Dovish signals support gold. Hawkish signals pressure gold. 3 key takeaways and then we are done. Number 1, gold rebounded to $5,000 per ounce after the biggest single-day crash since 1983. The recovery happened within days, driven by buying interest from Asian traders who viewed the crash as an opportunity. Gold's 30-day volatility hit 44%, the highest since 2008, actually exceeding Bitcoin's volatility during the same period. Despite this extreme stress test, gold recovered. That resilience tells you the underlying demand is real and the bull market remains intact. Number 2, every major bank maintains bullish forecasts for gold. JP Morgan targets $6,300 by end of 2026. UBS targets $6,200 by September 2026. Deutsche Bank and Société Générale see $6,000 or higher. The thesis is supported by central bank demand of approximately 800 metric tons expected, anticipated Fed rate cuts, ongoing inflationary pressures, and persistent geopolitical tensions. Institutional money remains long-term bullish despite short-term volatility. Number 3, gold outperformed Bitcoin dramatically over the past 12 months. Gold plus 66%, Bitcoin minus 21%. The market has decided which asset is the true safe haven. During the recent crash and recovery, gold rebounded while Bitcoin continued falling. The narrative that Bitcoin replaces gold has been contradicted by actual performance. For investors seeking defensive assets during uncertainty, gold has proven its value while Bitcoin has not. Let me leave you with this thought. Markets test your conviction. That is what they do. The crash we just witnessed was a test. It was a test of whether gold holders truly believe in their thesis or whether they would panic and sell at the worst possible moment. Those who sold at the bottom failed the test. Those who held or added to positions passed the test. And now those who held are back to where they started, while those who sold locked in losses. The next test will come. There will be more volatility. There will be more margin hikes. There will be more scary headlines. That is guaranteed. What is not guaranteed is your reaction. Will you have the conviction to hold through the storm? Will you have the preparation to add at lower prices? Or will you panic and sell exactly when you should be buying? The answer to that question depends on your understanding of why you own gold in the first place. If you own gold because you believe in the long-term thesis of central bank accumulation, de-dollarization, inflation protection, and geopolitical hedging, then short-term volatility should not shake your conviction. The thesis has not changed, only the price has changed. And if the thesis is intact, lower prices are opportunities, not threats. If you own gold because you were chasing momentum and hoping for quick profits, then you were exposed during this crash. Momentum traders get destroyed by volatility. Long-term believers use volatility to their advantage. Know which category you are in, position accordingly, and have a plan before the next crash happens, not during it. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frame. Are you trading on daily charts or investing on decade-long theses? Your answer determines how you should interpret everything I have told you. Plan and position accordingly. And drop your thoughts in the comments. Where are you watching from? What is your gold price prediction for end of 2026? Do you agree with JP Morgan's $6,300 target? I read every comment, and they help shape what topics I cover next. The bull market continues. The volatility continues. Stay sharp, stay informed, and make decisions based on data and logic, not fear and emotion. This is MSAR AG, Asian Guy, bringing you the complete picture. I will see you in the next one.